Is trading every month and putting in an automatically carried out order on an ETF, is that a good idea? Is one of the questions that we're hearing these days. After Christmas, now we have the new year. A lot of people want to get into the stock market. And the easy way to do it is to just let the broker carry out an automatic order for you. But is that a good idea? We'll be discussing that in this episode. You're listening to Investing Mastermind Podcast, and I'm Signe Lundholt.
I'm Michelle Markey.
So when you sign up with a broker, there's this functionality that allows you to place an automatic order. It could be, for example, investing in an ETF or a mutual fund, or maybe in stocks. And one of the questions that we hear these days is that a good idea? It's an easy way to get into the market and to start investing right away. What do you think about that question, Michelle?
For some people that just want to set up something one time and not really have to think about it, and they're comfortable with the ETF that makes sense to them. Like, let's say you get a low cost S&P 500 ETF, then maybe you just want to invest in the general market of America and say, I believe in these companies, like all the biggest 500 companies in America, and I think they'll do just fine. And you don't really mind what price you pay, then it might be all right as a just set in forget it strategy where you might already be familiar with this, like in your 401k, in a lot of Americans' retirement accounts. If you have a 401k, often you select which funds you want to invest in. And then every time you have your paycheck, your employer takes out money from there and then just automatically invests it in some of the mutual funds that you've selected. So in some ways, you might already be used to it because you've been doing it in a 401k for many years. But if you're trying to make that decision for your own personal brokerage account, that could be where it gets a little interesting. And what do you think, Sina?
Well, regarding the automatic transfers, I think it is quite risky because there's a lot of funds out there. There's a lot of ETFs. I think what you're saying, Michelle, about a S&P 500, you're betting on that the American economy will grow in the future. So in my opinion, that is less risky. But what I see is that people want to invest in an ETF from Cathie Wood or any other fund manager that we don't necessarily have a lot of track record on. We want years of track record in order to see how are they performing, are their strategy performing. There are some of these ETFs out there that are quite risky to invest in. So if you don't know what you're doing and just putting your money into something risky, it could be one of the recent fads with AI, ESG, other kinds of stocks that are getting momentum right now. It could be risky business. So you really need to think about it, that it's not necessarily a good idea to invest that way. It's not necessarily a smart idea to put your money into an mutual fund or ETF month after month and then risking your hard-earned money investing that way. That's my opinion. There are ways to do it less risky, like Michelle, what you mentioned about maybe betting on the S&P 500, where you're looking at America and hopefully America will grow in the future. Hence, your S&P 500 ETF will grow. But to just mindlessly pick some stocks that you might have heard about on social media or ETFs for that matter, I think that's very risky to do that and then every month continue to go down that path. In connection to what I just mentioned, this is kind of tied up with a theory that's called dollar cost averaging, which means that every month you are automatically or you are putting money into an investment, and sometimes the market goes up and sometimes the market will go down again. But because you continuously invest in that fund or in that stock, you get an average. However, what we often see is that when the market is going down, then people actually stop spending money on stocks or ETFs, and they're waiting until the market goes up again. And then you actually missed the good opportunity of when the market is down. And that's just where we see a lot of people, they believe, oh, I can do it. I can do the dollar cost averaging strategy. But then when push comes to shove and the market is going down, they get cold feet and don't act. They stop doing what they're supposed to be doing. And hence their track record won't be good because they only buy when the market is going up. And there's done a lot of studies on this, and the theory proves to not be necessarily the best to do. But I think, like you say, Michelle, if you don't want to be an active investor and if you want to be passive, of course it is the way to do it. The way to do it is then to not get cold feet when the market is down.
Yeah, that's right. So that's why I mentioned earlier, if you just want to set it, forget it, you have to be willing to accept whatever price the market's giving you. And let's take, for example, if you're used to buying a gallon of milk in the grocery store, you might be used to paying $4 for that gallon. And in a similar way, let's say that's a fair price. And in the stock market, maybe you're buying a stock or an ETF for $4 a share. So if you think of it like that, if the gallon of milk comes down to a price of $3 a gallon, you get happy because you get to save $1 and you're like, I got a great price for this gallon of milk, and you're going to do so much with that gallon of milk. And similarly, you should think of that in the stock market. If you're buying a high quality item that you like, that you believe in, you can invest in it at a lower price because you're getting better value for it in the long term, the longer you tend to stay invested in it. Because let's say you buy a stock for $3 a share, and someday it might go to $6 a share, which would be great. But if you wait and you don't buy the stock or ETF right away, and let's say one day the stock market is offering you $5 a share, that would be kind of like buying that gallon of milk for $5. You're paying $1 more, and you kind of are like, oh man, I had to pay extra when I normally pay only $4. So if you think of it like that, it might still be all right. It's within an acceptable range of what you're willing to pay, between the $3 to $5 range for either a gallon of milk or a share in the stock market. But you have to be cognizant that you're paying more. So it's kind of funny because we get a little bit opposite in our feelings. Like when we see grocery items on sale, we tend to get happy because we're saving money. But when it comes to the stock market, people tend to get unhappy when they see a stock or ETF that they invested in go down in price. But you get happy when you see it go up in price. But you shouldn't be happy when you're paying for it. You should be happy to pay a lower price for it, even in the stock market, as long as it's a high quality stock you're getting.
That's a great point too. When people come and ask right now if it's a good time, I oftentimes also say, I don't know if it's a good time to start your dollar cost averaging sort of stock savings account right now. That's often, when people come and ask, it's often because, oh yeah, instead of a savings account, should I start doing this now? And I say, in my opinion, it's not the right time right now. And the reason for that is because of the Buffett indicator. And the Buffett indicator is, Warren Buffett said that GDP was a great measure of, the stock market's overall health. So what we usually do is we go into the Wilshire 5000 market index that is being measured and compared to the GDP of the United States. And the GDP is the gross domestic product in the United States. And there is a website where we can see a graph where this Wilshire 5000 market index is compared to the GDP. And the reason why the Wilshire is interesting is because there's 5,000 stocks in there. So it's like from the US, it's a broad market index from the US. What we've heard Buffett say is that when it's over one, then stocks are expensive. And right now, what we see is that it's at 1.6. So according to Buffett, the stock market is expensive right now. When that is said, I also want to mention that it's been like that for years. It's been above one for years, and it's been going up, and it's been, at the max back in 2021. It was at 1.9, so almost 2, so almost double as what Buffett said. So I don't know if that measure is still accurate or if we should be looking at something different. Did the world change? Did the stock market change? It's difficult to know, but as a rule of thumb, when you look at that index, my response is that the market is expensive right now and that people probably should go put their money in a high yield savings account if they have access to that. So usually right now, what I would say is to put your money into a high yield savings account with a shorter term commitment rather than, for example, in a long term commitment in a short-term high-yield savings account. And then when we see that the Buffett indicator is around 1 or below 1, then it might be time to move your money into the stock market. That's what I usually say, but I know there's other opinions out there.
Some of what you're talking about is like if you want to keep your money liquid, you could find a high yield savings. I've talked about some of them in some of my YouTube videos before of high yield bank accounts where there's little or no strings attached and you have access to take out your money pretty quickly, as opposed to what you were describing in the longer term commitment, which was a certificate of deposit or CD, where your money can be committed for several months to multiple years. And you might squeeze a little bit of extra decimal points of percentage. Like instead of, say, a high yield savings account giving you 5%, maybe a CD might give you 5.25%. And you're like, ooh, another 0.25%. But then you're locked up for 2 years. So you may or may not want to be locked up for that long. I know I don't. I'd rather have access to my money so that I can deploy it where I need to in order to get the best deal for whatever opportunity might come along. And that could be, I've been more defensive in the past. Like these last several years, I'd been sitting more on the sidelines, I'd been more in cash. And it's a little bit tricky because we've been taught in this way of the Buffett style to value cash. Like even Buffett himself said last year words along the lines of cash is still king. So even though it may be, and Berkshire Hathaway's been sitting in tons of cash, there are other super investors that say they're fully invested, and we could be at the beginning of a bull market, and maybe if 2022 was the low in the stock market during this current cycle, then some of us already have been starting to miss out. We should have invested way more in 2022, and we've just been twiddling our thumbs sitting in a high yield savings account in 2023, like I have. So, I'm not trying to shame anybody. Like, I feel like I missed out perhaps because I think the stock market last year, like if you look at the S&P 500, it returned something crazy, like 26% last year. And I only got 5% from a silly high yield savings account. So, when you think about that, I missed out on 21% maybe. So I kind of feel a little bit salty in that, like, if I would have just done what some people are doing and just set it and forget it, invest even if the stock market goes up and down, because I might have gotten a better outcome if I just would have done that instead of stubbornly sitting in cash, and it didn't really do me that good. So, you make some of these opportunity choices, like, and there's opportunity cost, no matter what you do, but you just have to try to do the best you can. So if that were the case, on the flip side of, even though you think it's expensive, like it's hard, it's like very counterintuitive, but maybe things have really changed. Maybe the days of yore when Buffett could get in the stock market, like in the great financial crisis, and it went below 100%, and he was able to buy stocks at a 60 to 80% of the value of the Wilshire 5000 to GDP. Maybe those times are over. Maybe we will never get that lucky again. Kind of like what Charlie Munger said, that it's going to be tough for investors now going forward. He kind of was like, yeah, it's not going to be that good for people now, as good as it maybe was 50 years ago. So, maybe times really have changed, and we just have to accept that, much like real estate, like housing prices are going through the roof and stock market prices are going through the roof, but unfortunately, it might only be the only game in town. So maybe we could be waiting another decade before the market really, really crashes. Like, who knows? So it's sort of like a tough place to be because do you continue sitting on the sidelines or do you just suck it up and buy into big tech and an index fund like Charlie Munger said in some of his last advice he gave before he died? Like, we might just have to accept the way things are, and it kind of is a little bit annoying because you're like, I wish I could get into some of these at lower prices. Like, I wish I could buy that gallon of milk for only $3, but maybe I have to accept that now I have to buy it at $4.50 per gallon. Like, maybe I'm not paying all the way the $5 a gallon, but I just have to accept it is the way it is. So, you know, we kind of have the struggle. You're trying to get the best deal, but if we keep waiting, we might continue missing out, and that might be the biggest mistake of all of continuing to not be fully invested in the stock market.
Yeah, and I remember Munger mentioned that at the annual meeting that he did not believe that value investors would be having a very good time over the next couple of years. And I remember Buffett's remark to that, and that was as long as, people are acting foolish, there's going to be opportunities in the market. So it's super difficult. And I also think, we're trying to look out in the future and predict the future. That's very difficult. And that's why instead of automatically investing money every month, what I would prefer 100% was to do my homework and study a business, find out, is it sickly or is it healthy? Does it have management with talent and integrity? Does it have a sustainable moat, a competitive advantage where it's a winner better than their competitors? And then get it at a fantastic price, a favorable price. In my opinion, that's still the way to do it instead of passively just letting your money go into some, stock or ETF that you don't know much about and just not getting educated about the market so that you can't make some of the decisions. You can hear on, the discussion that Michelle and I are having today. We're both saying, okay, but this is an opinion and this is an opinion. And so you get that 360 view of we don't know what will happen in the future. Some say this and some believe that. And, we're hoping and guessing when we do it like that. So any day I would prefer to know what I'm doing and follow my strategy, whether or not we're at a new time in history where we've reached a new plateau, or listening to what Buffett said many years ago about his indicator of the overall market. But I hope that this discussion was valuable to you guys out there and found some of our points interesting, and it will help you in your investing practice and how you invest so that you don't just risk your hard-earned money doing something that you might not know about. Michelle, do you have any closing remarks?
Yeah, and even though I was presenting more of the flip side, I tend to agree with what Sina said. To follow a process that is still tried and true, like Buffett has demonstrated over decades. Like, instead of just blindly contributing every month and dollar cost averaging, you can do that if you don't really want to be so in tune with your investments. Like, if you just want to trust the market, set and forget it, contribute, $100 a month to an S&P 500 index fund, a lot of super investors, including Buffett, will say that's totally fine. Just do that if you don't want to be too committed to the process. But if you are someone like Sina and I who are really in tune with your finances and investments, you might want to care more. And I care more because I think I would regret it more if I just, threw up my hands and just capitulated entirely. Like, I don't feel super comfortable doing that either. So I would rather take more time and also take my time to be able to study things and invest chunks of money. Like, I'm more of that type where I gather some pile of cash and I like to deploy it in certain time frames that I like to put the money in. So I don't just do dollar cost averaging myself, but that could be a strategy that very well works for some people out there. So just because it's not what Sina and I do doesn't mean that it's not a good idea for you. It could be. So explore all your options, and just try to do the best thing that you believe is right for you and the people you care about. And as long as you don't have any regrets, that's what's most important.
And with that amazing advice, we're going to say goodbye for now, and we'll be back on Tuesday.
Till next time.
If you enjoyed the show and found the content informational, we would be super grateful if you would leave us a review and follow us wherever you get your podcasts so you automatically get new episodes in your feed. We publish a new show every Tuesday.
The contents of the Investing Mastermind podcast are for educational, informational, and entertainment purposes only. None of this is investing advice, and if you need help in your personal situation, please consult with a professional.